Welcome to Shadow of Truth and with your host, Dave Kranzler from InvestmentResearchDynamics.com and Rory Hall from thedailycoin.org. And today is Thursday, March the 3rd, 2016. The U.S. Mint has been on ration sales, as you well know, since July, August of 2015.
Uh-huh.
And there's no end in sight to that. And you believe that the Mint doesn't want to allow the sales to get to market level, to what market demand actually is, because that would take away too much from the industrial side. They don't want to have 100 million Silver Eagles, being produced, because I mean it's
Right.
already at 60 million, or they're on pace for 60 million this year. At least 50 there. I mean, minimum. So, which will be another record year. I mean, they don't want that. What are your thoughts on that?
Well, I don't know that I specifically tied it into industrial versus mint demand. I think they want to regulate it's basically another form of price control by regulating the amount of Silver Eagles that the mint produces. And they're not supposed to. By law, they're supposed to produce as much as there is demand. But no one cares about the laws anymore. No one cares what the laws say. There is no rule of law.
Correct.
So I think I honestly think that after every time they've ever had one of these shortages developed, I think they read the riot act to whoever supplies the mint and to the mint itself and just says, look, we can't let this happen, because it creates all that stir in the blogosphere and it puts a lot of attention on the supply of silver. I think they ultimately have a bigger problem with their supply of silver. And many of us have been speculating, the Bill Murphy community have been speculating for quite some time that their problem with regard to the supply and demand imbalance in silver is much worse than it is in gold. Because gold, they can just, go in and raid countries and take their gold, like they did with Ukraine and like they basically did with Venezuela, they did with Libya. They can almost all the ground that was gold that's ever been produced is above ground somewhere.
Yes.
So they can hypothecate, they can steal, and ultimately they're going to run out of gold, but silver's harder because 70% of all silver that gets mined is actually used up in industrial processes.
Exactly. I mean, well, and according to Eric Sprott, I don't know if you listened to that interview I did with him about 10 days ago or so. I mean, he was saying that only about 20% of the silver is available for investment, which would mean an even smaller pie. So
that could be true. I don't, who knows? And obviously we know about the solar programs going on in India and China, and that's putting a lot of stress on the demand, on the supply of silver.
Yes. And
so I think there's a much bigger stress in the supply of silver versus demand than there is in the gold market. And I think one of the ways that they regulate the price of silver is regulate the demand from the retail side.
There you go.
Because think if they just said, okay, we're going to get the mint, make sure the mint gets as much silver as it needs in order to meet demand. I mean, if you had 60, 70 million ounces at the margin being consumed by the American public, I mean, the price of silver would go through the roof. They'd have to. The only way to regulate, the more appropriate way to regulate supply and demand is let the natural market do it. Let the price do it. So if the demand is greater than the supply, let the price rise.
Exactly. You
that's
allow the laws of economics to work.
Right. Well, they would never want to do that. I mean, and actually, when you look at the way the mint works, is that in the law itself, originally, all of the silver that was used by the mint to produce Silver Eagles was supposed to come from U.S. mines. Well, around 2010, all of a sudden the demand for Silver Eagles, and that's about 40 million ounces a year. Well, all of a sudden, they couldn't produce enough silver from U.S. mines to satisfy mint demand. So then Congress amended the law and made it so that silver from Mexico could also be used.
Because they had to. They didn't have any choice.
They didn't have a choice because the law said they have to produce as many silver eagles as is necessary to meet demand. Well, now they've skirted that law by just, allocating, if there's all this silver and the price of silver is so low, then how come they can't supply enough silver to the mint?
Exactly. That's exactly it. If you go back to 2008 or 2007, there was 10 million eagles sold that year. And in 2008, when the economy went completely off the rails, it doubled, went to 20 million. And now we've gone up 2.5 times from there, almost 2.5 times. Because last year was 47 million. And that's just in 7 years. So we've actually had a 4-fold increase, 4.5-fold increase from 2007 to 2015, from 10 million to 47 million. That's a huge growth, and it's crazy.
Yeah, no, it's insane, and they never expected this to happen.
Right.
And so their way to treat their problem, or the way to address this, is they implement price controls.
Exactly. And instead of they have price controls, and they have the ration sales.
Well, and that's what I mean though by price controls. I'm saying, what my point is that the price controls or the rationing is just another form of price control.
Okay. Well,
because rationing the price also lets them keep a lid on the price of silver as much as possible.
And like you said, keeps it out of the news.
And it keeps it out of the news, right? I mean, if they were to let the price of silver free float, let's say the natural price of silver is $50 an ounce, it doesn't really matter what price you stick on it. It's obvious the price should be a lot higher than it is now because there's more demand than there is supply. So let the price rise, and you're going to curtail demand to more balance out supply and demand. So let's say the price of silver was $50 an ounce, you'd probably have a pretty substantial decrease in the amount of silver eagles the mint sells, or a decrease in the demand for silver eagles and the amount demanded.
Right. I think that if it were to free float and based on the laws of economics, I think it would be a lot higher than $50 an ounce.
Yeah, well, I mean, who knows? That point's, that the price itself is open to debate. Whether or not the price should be higher is not open to debate.
Correct. And we are very honored to have back on the line Mr. James Turk from Bit Gold and Gold Money. How you doing today, James?
Yeah, good, Rory, and hi, Dave. Good to talk to you guys.
Well, we're glad you're here.
So, James, you probably don't remember this, but I kept the email because I thought it might be relevant for our session today. And we were discussing the gold market and what was going on in price action wise. And you had responded regarding gold. I think our time has finally arrived. Everything is falling into place. The paper market continues to separate from the physical market, both for gold and silver. March OTC silver option expiry should be interesting at the end of this month. Well, obviously, we've seen how everything is unfolded. And this was on February 5th. I think initially on Friday, it looked like they were going to try and hammer everything. And it seems like this week we've gotten a surprise rally. So I'd like to hear kind of your follow-up thoughts to, the comment that everything has finally arrived and everything's falling into place.
Yeah. One of these days, the option sellers, the sellers of calls, are going to have their head handed to them. And I thought it might happen at the end of February for the March deliveries, but it hasn't. But just generally, let's just look at what happened last week. very similar to what's happened many, many times in the past. That last week of the month when the COMEX options expire and then the over-the-counter options expire here in London, the price is driven down to as low as level as they can possibly do it, so that all of the calls that have been sold at above the price at which the market closes at option expiry, all those calls expire out of the money, meaning that the people who sold those calls, the premium goes right into their pocket, all the premium money they received when they sold the calls. And we've seen this time and time again. But one of these days, we're going to see the opposite, where you just see the price continue to rise at an option expiry. And the reason for this is that the over-the-counter options that are written over here in Europe, you can choose that the option is settled for cash, or you can choose that the option is settled for metal. And one of the things I've been looking for is the option buyers to take delivery of metal rather than trying to settle in cash. And as the options come to expiry, the people who have sold those options have to scramble to get the metal if anticipation that they're going to be forced to deliver metal against them. And that, I think, could lead to a big short squeeze, because there is this imbalance, which goes back to the point of that email, between the paper market and the physical market. We've seen it in many different ways. We're seeing it by the huge premiums in coin sales, or the lack of metal from time to time, or the mint stopping to sell silver coins because they don't have the metal to provide. We're also seeing it in terms of the backwardation, the way the market is trading, which is in theory not supposed to happen, but it's been happening ever since January 2013, when the government announced QE3 and has been very heavily involved in keeping the gold price and the silver price under control. And we're seeing that control, again today. The algorithms come out when gold is up 1% from the previous COMEX close, and they start selling and selling and selling. And the open interest on the COMEX has been expanding as these algorithms have been selling. It's an indication that the government is intervening in the market and trying to keep a lid on both the gold and silver price. So, we've got this to deal with. But we've been dealing with it for 15 years, and we're getting to the stage where, with everything going on in the world around us, the governments are starting to lose control.
I just wanted to circle back here to your comment that it at least on the surface, it doesn't look like the LBMA OTC call riders in silver were necessarily squeezed, because they were able to push prices down, at least on Friday. However, and on Friday and over the weekend, just droves of articles came out about how gold and silver are technically overbought. We're going to see a sell-off because of that. There's a huge imbalance between the commercial, or the bullion bank shorts and the hedge fund longs per the Commitment of Traders report, which you and I both don't put a lot of stock into necessarily. But typically when we do see this kind of setup in terms of the way the COT is structured right now, there's usually a huge price correction in the metals. And a lot of analysts were basing their, some people were coming out and saying, oh, $14 silver is, a layup. Well, as it turns out, and this is to my surprise too, the action in the metals this week is completely defying all of these quote unquote expert predictions about what was going to happen with the price. And in fact, we're right now, we're higher in the price of gold than we were at any point last week. Well, almost any point last week, going into COMEX options expiry and the LBMA OTC options expiry. I'm wondering if this might actually be an indication that your premise actually may be playing out. We're just not, and this is the evidence that we're seeing it, because it certainly seems there's a dislocation in the market right now versus what's happened. As you say, we've been dealing with this over the last 15 years.
I think you're basically right. And what we're seeing today is the reaction to what happened last week. Remember, they can force a market into a certain price level, but that has to be met with metal if people are asking for metal to be delivered at those low prices. And metal is very scarce. And the governments who are intervening in the markets know that they only have so much metal to make available. So what they'll do is, after raiding the market like last week during option expiry, capping the price, forcing it down, they'll step back. So today you're seeing the reaction, or this week you're seeing the reaction where they're stepping back and allowing the market to go back up to a higher level, because as the price rise, less people will ask for physical metal. It's the bargain hunters that are in there under $15 an ounce on silver, but they're not going to chase it on the upside. And the other thing about whether a market is overbought or oversold, both gold and silver are so cheap relative to historical norms and historical valuations that it doesn't matter if it's overbought. It can stay overbought on a short-term basis for a long, long time, longer than we possibly expect. So to me, what's important is not really any short-term overbought or oversold indicators, but what the trend is. And to me, the trend is higher in both gold and silver, and it has been that way since the lows were made back in December. And I'm measuring this basically by saying, gold is above all of its short-term moving averages. And in fact, here at 1255, this is the highest price it's been since the beginning of February.
Does sentiment play a part in all of this, as far as the overall market is concerned, even down to the retail investors like myself? And how does sentiment play into everything that you guys have just been discussing, as far as this price movement and the big money coming into the market and doing what they're doing?
Yeah, that's a really good question. Sentiment does have a big role to play. And look at it from this point of view. These guys that are talking about an overbought market, do they really own any metal? Did they buy
Right.
it back in December or January? And, they remember metal being, gold being under $1,100, and they remember silver being under $14. And they're standing there waiting for it to come back. But when the train leaves the station at the beginning of a bull market, it's left the station. It's not going to come back. And I don't think gold and silver are going back silver's not going back under $14. Gold's not going back under $1,200, I think. What we really need, though, is a little bit more strength in silver. And this is something I've been focusing on for a couple weeks now, because the gold-silver ratio is up around 80 ounces of silver to 1 ounce of gold. We've been no higher than that for the past 20 years or so. And every time we got up to that 80 level, that marked an important turning point in the markets, where silver started outperforming gold and the ratio would fall. Back in 2011, when silver went up to $50, the ratio fell all the way to 31 ounces of silver to 1 ounce of gold. So I think going forward from here, we have to watch that gold-silver ratio, and in fact, whether it's going to fall. And it's still stuck around that 80 area, but I think if we can get a little bit more momentum in silver, then you're going to see the people pile on silver as well, and that'll cause the ratio to start falling, and that'll be, for me, the important confirmation that the bull market is definitely underway. Because what you want to do is you want to always look at the weakest asset, or the weakest component of a sector. When that weakest component finally starts to move, then you know the bull market is underway for real. And in this case, silver is still not quite moving, but I think it's about ready to.
Do you think that we are either in the third phase of this current gold bull market, or are we on the doorstep? Where do you see us as far as that aspect of it, James?
Well, we have to define our time frame. The bull market, in my view, started in February of 1913 with the creation of the Federal Reserve.
That's a great point.
So we've got 100 years of debasement, just like the Roman Empire had 100 years of debasement of the denarius, which was the Roman coin, the basic unit of account. So yeah, it's a long-term bull market in gold and a long-term bear market in the dollar. But just looking at it over the past, let's say, decade, we had the big move from 2000 up to 2011 when gold went from under $300 to over $1,900. Now we've been in a 4-year correction, correcting that big move, and that's a long time for a correction in a bull market, suggesting that gold is about ready to move again. And I think that's what we're seeing so far this year. It's to me early indications that we're in the early stages of the next big move in gold, which will take it above $1,900 an ounce when this move really gets underway. Whether that's going to happen this year or next year, only time will tell. I'm just taking it one day at a time. But I think we've seen enough evidence here to suggest that, yes, finally, after a 4-year correction, the metals are going to start turning higher. And what we have to do is just look, from day to day. That's why I'm focusing on things like the gold-silver ratio, and seeing for that to start falling again, or silver to break above resistance around 18 or 1850. But I got to admit, with gold here at 1255, 1256, this thing looks like it's getting ready to break out of the short-term consolidation it's been in the last 2 weeks of February.
We can only hope. And with the announcement of the ABX market opening up and China making yet another announcement that they're going to open up the physical futures market in Shanghai, and they actually pegged a date of April the 9th. What impact, especially in light of what happened on January the 28th when the LBMA blew apart basically and had that 80-cent difference in futures and spot price on silver, what impact do you see these two physical markets having on the LBMA, on the COMEX, if any impact?
Yeah, the changes that were made to the London fix were quite significant. First of all, the term fixed is used in a nautical sense, in that you're fixing at a certain point in the distance, and you eventually reach that point when the amount of physical metal offered for sale is equal to the amount of physical metal that somebody wants to buy. And at that instant in time, there is a fix. It's that price that clears the market. Now, under the old arrangements, the banks had the responsibility, the tacit responsibility, because it wasn't written in ink anywhere, to maintain an orderly market during the fixing process. So you wouldn't have instances like occurred back in January when the two markets completely divorced. All of that has changed. What's happened now, the banks no longer have that responsibility. The responsibility has shifted to the CME and Thomson Reuters, which run the fix now. But neither the CME nor the Thomson Reuters are market makers, so they don't have any responsibility for maintaining an orderly market during the fix. So the banks can actually see what's going on during the fix, and they can game the system. So, they gamed the system on January 28th, and whoever was participating in the silver fix on that day ended up getting ripped off if they think they were going to sell above at a price that was much higher, 1 minute before the fix,
Right.
And again 1 minute after the fix. They got ripped off. It was gamed by the banks. So the changes that they made to the whole fixing system were a step backward rather than a step forward, because it essentially removed all the responsibility off the banks to maintain an orderly market during the fixing process.
So you don't necessarily see any kind of impact from ABX or Shanghai's future physical market?
Brick by brick, all of these things are important and significant. And, as is that fix on January 28th, that's just as significant. What it's doing is it's destroying the credibility of the London market. And when you're destroying the credibility of the London market and developing alternatives in other parts of the world, business is going to flow from London to those other parts of the world in terms of determining what is the real price of gold or silver at any given moment in time. And when I talk about gold or silver, of course, I'm talking about physical gold and silver, not the games they play on the paper side of the market.
Yeah, paper doesn't count.
It doesn't count. at the end of the day, but it does count from time to time because it can be an influence on the price. And this is the point that Dave was bringing up with regard to the email I had sent back in early February. The two markets are totally different, but they intersect at a price. And there is a normal intersection when gold and silver in contango, and there's an abnormal intersection when gold and silver are in backwardation. And since January 2013, we've been in an abnormal situation because of government intervention, which means that they've been using the paper market to keep the price of physical gold and silver too low, and that physical gold and silver is being scooped up by a variety of different people around the world who understand what exceptionally good value physical gold and physical silver are at the moment.
James, I just wanted to circle back really quickly on something you had mentioned. And I'm glad you brought it up. And then I think we can wrap this up, let you get on your day. But, on your evening, I should say. But you brought up the topic of that phony London silver fix. 1358, I think, was the fixed price. The futures had been trading around 1430 at the time, I believe. They fixed it at 1358 instantaneously, and then almost instantaneously the futures prices were back up at like 1420, 1430. Have you, and I'm actually surprised there was no formal investigation into what happened, because that was totally a complete rig job. And have you heard anything over in London about exactly what happened or how they pulled it off or what they were trying to do?
Well, it's the way the fixing process works. You have what's called a round, and at the end of a round, you see how many bars, and here I'm talking about 1,000-ounce silver bars, are offered for sale versus how many bars people want to buy. And then you have a second round, and you see if you're any closer by bringing in new bids or offers. And you have a third round, and you keep on going until you finally balance. Well, in that one, you had 29 rounds. And what was happening was the banks that were entering the rounds just kept on lowering and lowering and lowering in order to force the price down, at which they then cleared the market at 1358. So it was entirely, a gaming of the system. And that's why I say, the steps that they've made are a step backward rather than a step forward, because the banks now have been relieved of any responsibility whatsoever of trying to maintain an orderly market. But the important point that you raised, Dave, is there is no follow-up. Why is there no follow-up? Because, again, the gold and silver markets are totally under control of governments. And, governments don't want to be exposed in terms of their intervention. And the banks don't want to be exposed anymore in terms of, what they're doing on behalf of governments or what they're doing for their own book. So it just, quietly gets swept under the rug. But the point is that, people around the world who participate in the market lose credibility when they see that happen, and therefore they're going to be looking at more and more alternatives in order to buy physical gold and physical silver. So that means the market is definitely moving away from London. The physical metal has been moving west to east, so it's sort of natural to think that the markets are also going to be moving west to east. And in fact, I just saw today that Hong Kong has announced the creation of a physical market for a futures market based on physical delivery. So it's another indication that Asia is going to be the center of gold and silver unless in the West governments and central banks stop this nonsense of trying to keep the gold price suppressed.
I asked you about sentiment, and I wanted to ask you about what you're seeing and hearing within BitGold as far as new accounts coming on board, or is that moving up in a way that indicates that people are moving away from fiat currency? And are you closer to getting that product available in the United States at this point?
Yeah, people can in the United States, or people who are resident in the United States, can open a BitGold account to buy BitGold. They just can't use it as a form of payment. Okay. They can apply for a BitGold card, a MasterCard, and use that, but they can't actually click gold from their account to someone else's account. But BitGold is doing extremely well. We released two things earlier this week. On Monday, we released the December 31st quarter results for Gold Money Incorporated, the parent company. And then on the 1st of March, we released the key performance indicators for both BitGold and for Gold Money. And there's, very, very good growth. But, you hit the point that is sort of interesting. You're talking about, exiting fiat money. The people that are opening accounts in BitGold and buying gold, more than half of these people have never bought gold before in their life.
Wow.
Which I find very, very interesting. This isn't gold bugs that are going into it. This is people who are looking for alternatives, maybe reacting to negative interest rates around the world. There are a lot of different reasons, but the key is it's people who've never bought gold before, and I think that's very, very significant.
That's huge.
Yeah.
I mean, because I've been interviewing quite a few people recently, and that's one of the key numbers that people that I've been focusing on, actually. And it started with a conversation I had with Dave probably a month ago, when we were talking about the sheer volume of investment dollars in the United States and versus the investment in physical gold and silver in the United States. And we figured that it's less than 1% of that total volume. And if you have just a small, very, very small percentage of new money to come in, new investment money to come into gold and silver, you're going to have some serious problems as far as physical.
Yeah, I agree wholeheartedly. And, that's why I keep jumping up and down about, you got to buy physical gold, physical silver, forget about the paper stuff. You want the real thing, in your hand, or, stored professionally for you somewhere around the world. You want to avoid the paper. You want the real thing. It comes down to, Rory, why are you buying gold or silver in the first place?
Exactly.
If you're buying to trade it, there are a lot of things. There are futures, there are options, there are ETFs. But if you're buying it because it's money and it's a safe haven, it preserves purchasing power over long periods of time, and particularly not because it's cheap relative to other assets and relative to its own historical normal valuations, you want the physical. You don't want the paper. And I can't stress that enough times. It's extremely important.
It is extremely important. That's why I want to keep it in front of everybody.
Yeah, no, I agree with you completely.
One more quick question. Are there any plans to take either Gold Money or BitGold public so us little people can invest in it? Because it's a great idea. It's a great business model.
Gold Money is already public. It's traded on the Toronto Stock Exchange. XAU.V is the symbol. It's trades. I don't know what the price is currently. It's been trading between $4.80 and $5 Canadian. There are approximately 64 million shares in issue, so the market cap is around 300 million Canadian dollars. And it's a public company. It's fully disclosed, so you can look at all of the information that we're reporting. Just go to the BitGold site, and there's an investor section that can give you all of the information that you require if you're looking about making an investment in Gold Money Incorporated itself.
Yeah, I was looking for the ticker for Gold Money, and I couldn't find a dollar-based OTC bulletin board symbol. So I guess the only way to access it is through the Toronto Venture Exchange.
Yes, that's correct. It's not listed for trading in the United States. So if you are an accredited investor or someone who can trade in the stocks in Canada, again, this is complex, but it depends on where you live and all of the other things. It's traded TSX symbol XAU.V.
There you go.
Very good.
Well, James, we certainly appreciate
James.
Yes, really appreciate all your time today, and I hope that we can do this in the not too distant future, James. It's been way too long since we last spoke with you.
Yeah, this is going to be quite an amazing year, and happy to chat with you, guys, anytime. So, keep me in mind for another chat down the road.
Sounds great.
Thanks, James. Have a great evening. I guess it's past tea time. It's cocktail time over there.
Yeah. I'm going to head for the gin and tonic.
Oh, well, enjoy it, sir, and enjoy your evening. We will talk with you soon.
Thanks very much. Bye-bye.
Bye-bye.
Bye.